So one of the key takeaway would be, try to look into other correlations that can actually exist with some form of early warning indicators and try to incorporate as part of your risk management framework, because that will give you a head start. And history is important, but how do you innovate so that you can capture that trends much in advance is the critical aspect of liquidity risk management, and so to say, for other risk types as well. But that's would be my key takeaway: be innovative, be resilient, and try to look for early warning indicators that can help you manage risk in a more robust way.
Hello, ladies and gentlemen, and welcome to our interview with Nidhi Singh. Nidhi is a director, Americas Treasury Risk at UBS New York City, and she has more than 12 years of experience and in quantitative risk, modeling, risk reporting to the board risk committees. Nidhi, welcome to our Risk Management Show podcast today.
Thank you, Boris, and it's a pleasure being here.
Absolutely. It's my pleasure too. So, Nidhi, I believe that we will have a thoughtful conversation on the very actual topic of liquidity risk outlook and impact due to Fed rate cuts on the funding rates. But before that, could you please tell us a short story about yourself, your career path, how you got started in your field, and what you're up to these days?
Oh, absolutely. So my career path has been pretty interesting, I would say, because I was pursuing my bachelor's in science and majoring in chemistry. And that's when the 2008-2009 crisis actually happened. So I kind of like got interested in the financial industry, and I made the decision that I need to pivot to the risk management domain. And I pursued my MBA in finance, and then I got into the quantitative risk modeling space. Started with credit risk, market risk, and now currently I'm working as a director in Americas Treasury Risk, especially focusing on the liquidity and funding risk side.
All right, fantastic. So let's go deeper into our topic, because now we have this timing of two rate cuts from the
Exactly.
Federal Reserve. And we have been experiencing high risk, high interest rate. And let me discuss how do recent Fed rate cuts affect liquidity risk for financial institutions, and what specific challenges are they likely to face?
So it's a very interesting timing for this question. And as you rightly mentioned, that we have had like the time that we're having this podcast, we have had like two rate cuts. So it's close to like 75 bips of rate cuts that we have seen up until now from the beginning of September. Now, it does come at a point where you have seen a very high interest rate. So if I recall correctly, there were like 11 rate hikes that happened in 14 months. And that kind of led to a lot of liquidity risk issues that we saw as part of the regional bank crisis. But, coming now to the current state, I think it definitely makes the funding source and access to the funding cheaper for a lot of the financial institutes. But at the same time, it does come with its own complexities. Now, what do I mean by that is a lot of the banks or the financial institutes, they depend heavily on the deposits that they currently hold as a cheap funding source. Now, as a depositor, when the interest rates are low, they would feel like, okay, probably like my high yield saving accounts are not giving me enough return as I would expect. And probably like, S&P is like doing really good. Like I might get like a very high return on that. So that results in the underlying liquidity drain to a lot of the financial institutes because they would see probably, we call it like the behavioral component of the depositor come and kick in. So it is very crucial time for any financial institute to manage their assets and liabilities duration to make sure that, okay, you are either perfectly hedged or, the maturity of your assets and your maturities of your liabilities are pretty much in sync. Otherwise, you lead to a lot of interest rate risk, and also the fact that, you would not be able to manage your liquidity on a very resilient manner. And also the pace of the way the rate cuts could happen. Now, given with the election results, like, the the Fed mandate to manage the inflation, at the same time, the employment rate, may see some changes because you may see different tariff rates kick in, so they may try to prolong the rate cuts for a much longer period. So that would impact the overall liquidity risk management within the financial institutes, because you may not expect like the kind of rate hikes that happen in 14 months to be same for, like, in 14 months you would see it at the same level. So a lot of the firms need to manage the funding sources that they have currently, at the same time, what duration they see their liabilities to mature. The additional complexity also comes for banks which are pretty much exposed to mortgage risk. So say, for example, if I have like huge mortgage portfolio sitting on my balance sheet, and these are fixed rate mortgages. Now, if there is a sudden spike in the rate cuts that happens, that would result in a lot of prepayment risk for banks. So with prepayment optionality that kicks in, your overall asset duration also becomes shorter, and the way you are managing your overall liquidity becomes challenging. So definitely there are risks associated with a sudden rate cuts that could happen, and at the same time, like, if the rate cuts are being managed on a day-to-day basis, uh, you need to be more resilient in the way that you are managing your overall balance sheet. So definitely, I see it a very challenging time for banks, which may become like your funding sources being cheaper, your net interest margin will also shrink. At the same time, you need to manage your assets and liability profile in a very resilient way.
Fantastic. That's a good explanation. So we know that on the way to up of the interest rate, some banks failed, like SVB. Maybe you
Mm-hmm.
can shortly explain us what happened and what risk management errors were made by these
Mm-hmm.
banks, so we can prevent on the way down
Mm-hmm.
to this to happen.
Yes, and I truly believe like each failure does come with its own set of uniqueness. And the way the regional bank crisis came into front foot uh, was dependent on a couple of things, I would say. So first of all, we were in the low interest rate regime. So a lot of the banks at that time during 2020 and 2021, they thought that fetching yield was something which was very difficult. So what they did was they kind of invested in long duration portfolio, and that resulted in probably getting them like a very short term higher net interest margin to say. Uh, but at the same time, most of the banks, they invested in, we call it like HTM portfolio, hold till maturity portfolio. So as a result, what happens is the way the HTM portfolios are accounted, you do not consider the economic value of your portfolio. So it's not mark to market portfolio. So when the Fed started raising the rates, all of a sudden these portfolio had the unrealized losses because those were not mark to market, so they were not reporting it. But at the same time, it did result in a lot of their capital strain. So once they started reselling these portfolio and realizing those losses, it came into social media. It did come into the news. It did come, and it resulted in contagion effect, which a lot of the prior recessions or recession stories did not have. And as a result, there was like a deposit withdrawal, and the peak of the deposit withdrawal was something very unprecedented that most of the financial institutions were not prepared for. So it did result in a lot of asset and liability mismatches, as well at the same time your cash flow mismatches. So you would have your liabilities which became like shorter and shorter because of the contagion effect. People got scared, and they started withdrawing their deposit amount from the financial institution. So I would say it was the 2 years of low rate regime, and all of a sudden the rate spike that kind of resulted in resulting in contagion effect, which was pretty much accelerated deposit withdrawal. And also, you did ask about the risk management failures, and something to highlight here is very important is that a lot of these banks were regional banks, and they were mid-sized banks. So the kind of regulatory scrutiny that they go through is not the same as any SIFI would incur. And when I say SIFI, it would mean like systematically important financial institutes. So they are considered like big institutes that can have like more of systemic risk. So the kind of regulatory scrutiny that these banks go through on an annual basis or a periodic regulatory review process that they go through was not as stringent as other big banks. So they were not looking into the ALM robustness or the interest rate risk that these banks were exposed to. Also, the kind of capital requirement that they had was less compared to a SIFI institutes. So these were the inherent weakness, I would say, that were part of, and that also resulted into these regional bank crises. And a lot of areas which we can definitely improve on. And I think I would also acknowledge like the regulators and including the FDIC, they did come into, they intervene at the right time to make sure that, the risk that happened was also contained after a point. So, for example, a lot of the banks that they could do is robustness and a framework in place. Also, the fact that the way these liabilities like deposit, because most of these banks are highly dependent on deposit as a chief funding source for them. So they need to model the behavioral aspect of deposit in a more robust manner. What it would essentially mean is you need to understand for different segments of customers that you have who are more sensitive to interest rate risk or who would probably try to go for like if it's a low rate environment, like who would try to go for an alternative investment option for them and probably withdraw it. So, you need to have like that kind of modeling capabilities to manage your liability. And for those liability, you need to manage your asset. The other areas that you could definitely do is try to make sure that your customers are aware of the FDIC insurance on their deposit, which is at $250,000. So if it's well communicated, that kind of helps them understand that, okay, their deposits are insured. So it definitely makes them more aware of that, the contagion effect that happened during 2023, that would probably not happen in the same pace. There are other ways to that a lot of the financial institutions have started looking into is making sure that they are adequately capitalized for any such risk. And these are the critical measures that you need to do. And one thing which I think is very important, and that's something which we are seeing like building across the industry, is making sure that the treasury is core function in terms of your financial plan that you do. Like a lot of times, like you would see like certain aspects of the business division, they may have their own financial plan, but treasury may not be like a center focal point for it. So as long as you integrate these processes, it definitely helps you in building a more robust ALM framework that you can work with.
Fantastic. So let's drill a little bit deeper. So, for example, if we take a life of a risk manager in liquidity space, so if there is one thing that they should start to prioritize right now that they are not doing currently, what would it be? Yeah, in the terms of liquidity risk and the current environment.
So definitely one area that is important is how you build out your stress testing capabilities. Now you need to manage what we have seen in the last 4 or 5 years. Like, we did have a big market risk like COVID, and we also had some idiosyncratic risk like with these regional banks. Now, how do you manage the market risk component at the same time? Idiosyncratic risk could be very different because you are for market risk, like you would have like different exposures associated with probably, your investment banking portfolio that you have, and there can be a high liquidity drain. However, for the idiosyncratic risk, we did see that, there was some deposit withdrawal. What I think on liquidity risk standpoint is very critical to make sure that the stress testing is robust. The underlying assumption that gets built out on this stress testing does take into account the recent outflows that we have seen. At the same time, it is important to make sure that level of capitalization to your portfolio is understanding your underlying portfolio is very important. So say, for example, right now we do know like the CRE loans are pretty much prominent, like for a lot of the regional banks. Now, how much they are capitalized to make sure that, with the higher interest rate, like, the kind of credit risk associated with the CRE loan could lead to default. At the same time, you will have lesser liquidity as because the loans that you have given may not materialize. So for that risk, how much capital do you have is something which is very critical to make sure that the kind of liquidity risk oversight that you have is managed. Also, having a robust limit framework definitely helps. You need to make sure that the liquidity risk appetite is also at the forefront to the board risk oversight and making sure that the underlying limits that you have aligns with the risk appetite for the bank or any financial institution that has been set up for. So I think there are numerous ways that you can streamline this, but understanding your balance sheet is the key, understanding the portfolio that you are exposed to and what are the inherent liquidity risks associated with those portfolio plays a critical role.
Mm-hmm. Awesome. So let's discuss a little bit more about kind of regulatory oversight. So because now probably because of the new administration, we will go to another regulatory framework. What role does a regulatory oversight play in managing liquidity risk in low interest environment, and how might regulators respond to increased liquidity pressures?
So I think, regulators play the pivotal role for any kind of liquidity risk oversight that you see. The first and foremost is they understand like which are the big banks that can result in, big systemic risk to the country. So they'll have their own periodic oversight that they do currently, and they look into the different areas that can result in the risk, any kind of risk to emanate. The other thing that they do is definitely coming, so they do have their own prescribed regulations, which is Reg W, Reg YY. On the US side, they also have different regulatory metrics that most of these banks, they actually report on a daily basis. And also some of these metrics are on the long-term basis and they report it on a monthly basis. So what does happen is, these regulatory metrics are in there, but we have seen that a lot of the banks, like, with a very high regulatory metric, they did fall. So it definitely questions that, okay, probably that's not enough. And you need to do more to understand, like, different aspect of the liquidity risk that can happen. So, for example, a lot of these regulations, they have started with a higher capitalization ratio that you need to maintain in order to come up with some unknown risk that is not part of any kind of regulatory metric that's not being covered for. So say, for example, the social media, it is not part of any kind of liquidity coverage ratio that any financial institution currently computes. So, you need to be prepared for unknown, and regulators have started understanding it. And, as part of their periodic review, they do try to understand like, okay, how you are managing the current liability base, which if your portfolio is highly concentrated on deposits. The other area which they have started scrutinizing more is on the interest rate risk, which definitely like happened after the regional bank crisis, is how much open interest rate risk position is currently with you. So, do you have a hedging program in place? And if not, why? And, what is the current risk appetite associated for an open interest rate risk that you manage? So definitely they play a very critical role. And being in the risk management field for quite some time, I think that it is a lot top down that comes into and making sure that the institution is resilient, and a lot of the regulatory regime that comes into play and the board's involvement into how much they are involved in managing day in day out of risk uh, plays a critical role in making sure that there is robust framework in place to manage it. Regulators have also started scrutinizing a lot of banks on different modeling, stress test modeling capabilities that they have. And they have also made sure that a lot of the banks, like regional banks, were not subject to, say, CCAR, and they want to make sure that the stress test that they currently do is more frequent and it does take into account like new scenarios, which probably in the past, were not taken care of. So, it's definitely a way forward, and it will definitely take some time in terms of making sure that the improvement comes into place.
All right. So I know that a majority of companies failed because of liquidity issues and the solvency issues. But I would like to ask you your personal point of view.
Mhm.
What is a major misconception in the field of liquidity risk that you strongly disagree with?
So one of the major concern that people have is like, okay, they see liquidity risk as like, okay, it's more like an operational risk. You manage it day in, day out. But what they probably don't understand is it is kind of interlinked with other material risk. Like, say, for example, if you have huge market risk component associated, now that will result in liquidity drains because you would have like your change in the overall initial margin or the variation margin that you put out for any clearing activities as an investment bank. So as a result, it has a direct impact on your liquidity profile that you currently maintain and your day-to-day funding sources, at the same time the cash flow activities that you manage. Similarly, as I said, like the CRE loans, people consider it as like credit risk. But at the end of the day, it will impact your liquidity profile as well, because more and more your loan portfolio is exposed to credit risk. The kind of asset duration that you expect out of it will not materialize. So it's more to do with the cash flow management. And it's not just the short-term cash flow management that people try to get confused with, like, okay, it's like, within 5 days, 10 days. But it definitely helps in optimizing your longer term cash flow horizon, and you can understand where exactly the risk pertains, and you can take mitigating actions accordingly. The other area which liquidity risk, and this is one area where a lot of the banks and financial institutions are working on, is the FTP, which is the transfer pricing. So within different domains or divisions of an organization, you understand the opportunity cost of the liquidity risk if the funds are being transferred from one division to another division. So that helps in bringing out the transparency. So a lot of the components of the liquidity risk are not just the operational aspect, it can be integrated to a long-term strategic planning that any organization could do. So, I think, that's kind of the misconception that people have. And, it is point of like a focal contact for all the other risks that could emanate. So say, for example, social media could be tagged as an operational risk, but it had impact on the way you manage your liquidity. Or even the COVID, like, it's classified as market risk, but at the end of the day, it's the liquidity of the financial institution that gets impacted. So I would say that it's kind of like interlinked to all the other risk which is associated with it. And that's when it makes it very interesting because you don't get siloed into one risk stripe. Rather, you have to have like a good understanding across the organization to make sure that the treasury is at the focal point and a front runner when all these crises kind of comes into front foot.
Mhm. All right. So if we summarize our interview for someone who is listening to it and would like to walk away with one or two major takeaways, what would it be?
So, one or two major takeaways would be number one is try to read more about like the historical financial crisis. And what you would understand is these financial crises, each one of them had its own uniqueness, which probably like we say that, okay, this happened in 2008, 2009, this happened in 2020 COVID period. But each one of them had its own uniqueness. And as a risk manager, you cannot have a fixed template to manage risk. You need to be resilient enough to anticipate things. And the most important thing is you need to be innovative in terms of how do you manage? How do you get some early warning indicator in place so that you try to understand, okay, you see these risks or you foresee these risks. So one of the key takeaway would be, try to look into other correlations that can actually exist with some form of early warning indicators and try to incorporate as part of your risk management framework, because that will give you a head start. And history is important, but how do you innovate so that, you can capture that trends much in advance is the critical aspect of liquidity risk management. And, so to say for other risk types as well. But, that's would be my key takeaway. Be innovative, be resilient, and, try to look for early warning indicators that can help you manage risk in a more robust way.
All right, fantastic. Thanks again, and I wish you a great success,
Mhm.
and you and your company, your UBS, and yeah, hopefully we can continue
Mhm.
with following interview maybe on another topic that is important to our audience.
Yeah, sure. Thank you so much. It was great talking to you.